All right, let's jump right in. We are going to decode one single really fascinating day in the financial markets, Tuesday, December 17th, 2025. It was a day that was just full of contradictions, some huge swings, and even a few historic moments. So, let's figure out what the numbers were really telling us. The one big question hanging over everything that day was this: are we in a bull market or a bear market? The signals were coming in hot and heavy from both sides, which created this real sense of uncertainty. So let's start with the overall mood. I like to think of this as the market's mood ring for the day. And even though there were some bright spots, and we'll get to those, I promise, the needle is pointing squarely at fear. And what that's telling us is that overwhelmingly, investors were feeling pretty nervous. They were looking to dial down their risk.
So to really understand that fear, we have to zoom out and look at the big picture. The story of this particular day wasn't one single trend. Nope. It was a market that was completely divided, with different parts of the economy telling totally different stories. Now check this out. This table captures that division perfectly, right here in the US markets. You can see the tech-heavy NASDAQ actually managed to finish in the green, but the S&P 500, which tracks 500 of the biggest companies, and the more industrial-focused Dow Jones both fell. So what was causing this split? Well, it was a classic tale of two sectors. On one side, you had tech, where Tesla soared over 3% to a record high. The reason? CEO Elon Musk confirmed they were testing fully autonomous robo-taxis. All that excitement for AI in the future kind of lifted the whole NASDAQ. But on the flip side, the energy sector was getting hammered. Oil prices plunged to their lowest point in over 4 years, all because of these nagging global economic concerns and fears of an oversupply. And that economic anxiety, it wasn't just hitting oil. Look at this. The pharma giant Pfizer dropped more than 5%. And why? Because they put out a forecast for 2026 that was a lot weaker than what analysts were hoping for. The main takeaway here is that this fear was spreading out, hitting multiple key parts of the economy. And that global pressure wasn't just contained to the US. Let's shift gears now and see how it directly slammed the Indian market, which was already facing its own set of challenges. Yeah, this chart, it tells the whole story, doesn't it? The Nifty 50 index, which tracks India's 50 largest companies, took a sharp 167-point loss. And this was the second straight day of declines. The market was under some serious selling pressure pretty much all day. And to make matters worse, the Indian rupee weakened for the fifth day in a row, closing at a new record low. A weaker currency can cause all sorts of economic headaches, and this was a huge red flag for investors. So why was all this happening? It really boils down to two main things. First, you've got these ongoing foreign fund outflows. Just think of that as the big international investment groups pulling their money out of the Indian market. And second, there's that global risk aversion we talked about earlier. When investors around the world get scared, they tend to pull their cash out of markets like India and park it in assets they see as safer. But hey, even on a day that's mostly red, the market is never just one single story. There are always individual companies that manage to buck the trend. So let's zoom in on some of the specific winners and losers to make these numbers feel a little more real. Okay, let's do a quick rapid-fire round here. The day's biggest loser on the Nifty 50 was Axis Bank, which fell a steep 5%. Ouch. But the top gainer was Titan Company, up over 1.6%. We also saw some really positive news for specific companies. Ahluwalia Contracts landed a massive construction order, and Keynes Technology announced a key partnership to help push India's semiconductor industry forward. It just goes to show, individual company stories can definitely swim against the current. And now for what I think is the most incredible data story of the day. Seriously, it involves a surprising showdown between two major commodities that ended in a super rare and historic market event. So, let me ask you a quick question. What do you think is more valuable right now? A whole barrel of crude oil or a single ounce of silver? For, most of modern history, the answer to that has been pretty obvious, but not on this day. And here's the punchline. For the first time in over 40 years, since 1980, an ounce of silver became more valuable than a barrel of oil. That is an absolutely incredible market flip, and it just shows you how dramatically the fortunes of these two commodities have split apart. I mean, this chart just lays out how staggering that split is. Since the middle of 2022, silver has surged an unbelievable 206%, while oil has dropped 44%. So what's going on? Well, analysts think fears of an economic slowdown are crushing oil demand, while silver is benefiting from its double-duty role as both an industrial metal for green tech and a safe haven asset against inflation. It's a total role reversal. with silver on track for its best year since 1979 and oil heading for its worst since the 2020 pandemic crash. Wow.
So, after a day with so many conflicting signals and historic shifts, what are investors looking at now? Let's pull out the investor's compass and see what the technical signs are hinting at for what might be coming next. We're back to the Nifty chart, but this time we're putting on our technical analyst hats. The two key numbers to watch are the resistance and support levels. Think of resistance at 26,858 as a ceiling that the market is really struggling to punch through, and support at 25,760, that's the floor. If the index breaks below that floor, it could trigger a whole lot more selling. And here is a key piece of market jargon that perfectly sums up that negative feeling: short buildup. All this really means is that a growing number of traders are placing bets that the market is going to keep falling. We saw this happening in both the Nifty and the Bank Nifty futures. And it was backed up by the fact that those foreign institutional investors we mentioned earlier were net sellers, meaning they sold more than they bought. And that leaves us right here with this final question. We've seen a market that's torn between optimism for tech and fear for the economy. We've seen a historic flip between oil and silver, and we're seeing technical signs that hint more downside could be coming. So the real question for every investor watching all this unfold is this: is this a time to be driven by fear, or is it a moment of hidden opportunity?
Welcome to the Deep Dive, where we take the crucial articles, research, and data points and turn them into clear, actionable understanding for you.
It's good to be here.
Today, we are witnessing something that, well, it should stop every seasoned market observer right in their tracks.
Yeah.
We're looking at a commodity anomaly that really has not been widely seen since the tail end of the 1970s and the very, very early 1980s.
It's truly a historic marker. And I want to be clear, this isn't just a minor fluctuation. We're not looking at, seasonal variance or a bit of market noise. This is symptomatic of profound, deep-seated structural macroeconomic shifts.
Yeah.
Shifts that are currently, I'd say, tearing through the global financial landscape.
And the central startling fact is this: for the first time in over 40 years, an ounce of silver now costs more than a barrel of crude oil.
Yeah.
Just let that sink in for a moment. Think about the gravity of that statement. For the entirety of the modern industrial age, oil has been the undisputed king.
Absolutely. The king.
It's been synonymous with geopolitical power, with industrial activity, global logistics, everything. Silver, meanwhile, has always been gold's quieter, sometimes overlooked cousin.
Mm-hmm.
An investment metal, sure, with industrial uses that always felt secondary to its role as, a safe haven.
Well, that script has been completely ripped up and rewritten, and it's been rewritten by the forces of technology. To really get the scale of this, we need to underscore the precise data we're seeing from our sources in late 2025.
Okay, let's have it.
As of December 17th, 1 ounce of silver is valued at approximately $65.50.
$65.50. Okay.
Now, look at the major energy benchmarks. A barrel of Brent crude oil is struggling down near $59.50.
Wow.
And COMEX WTI crude is sitting even lower, somewhere around $56.19.
So silver isn't just marginally matching oil. It's not even close. It is now priced over $6 higher than a barrel of WTI crude.
$6 higher.
When you consider the vast, the trillion-dollar infrastructure of global industry, transportation, and commerce that runs entirely on crude oil versus the relatively niche, though rapidly growing, market for silver, this inversion is just. It's shouting a message.
It's shouting a clear, unmistakable message about what the future global economy values most. This is the market performing a radical, long-term valuation assessment.
So it's not about today, it's about tomorrow.
Precisely. It's signaling that the structural forces of decarbonization, that mandatory global push toward net zero, and the intense reliance on high-tech digital infrastructure are overpowering the traditional drivers of energy demand.
Right.
This inversion reflects a fundamental reassessment of scarcity, but, and this is the key point, it's a reassessment of future utility in the new green economy.
I like that framing. Future utility.
Yeah. Oil provides energy for today. Silver provides the essential components for tomorrow.
Okay, let's unpack this, because this isn't just about a price tick on a screen. This is about understanding future economic direction. What does this historic reversal tell us of the future of energy production, high technology integration, and the role of traditional safe haven assets.
That's what we're here to do.
Our deep dive today will analyze the powerful, interconnected forces driving this unprecedented shift. We'll be examining market data and linking this huge macro movement to the immediate trading signals and the staggering corporate activity we saw around mid-December 2025.
And our mission for you, the learner, is critical today. We want you to walk away not just recognizing this price difference, but truly understanding the underlying structural economic forces, particularly the mandatory requirements of the clean energy transition that are rapidly and I'd argue irreversibly reshaping the valuation of assets globally.
So this is bigger than just two commodities.
Much bigger. We're dissecting a once in 40-year commodity anomaly. And the insights here, I think, will genuinely shape your view of the next decade.
That sets the stage perfectly. Now, moving into what we're calling the Great Divergence, we really need to quantify just how quickly and dramatically this inversion took place, because this wasn't a slow, stately march.
Not at all. It was a violent and, to many, a shocking turnaround. To truly grasp the magnitude of this shift, we only have to look back a few years. Let's anchor ourselves in, say, mid-2022.
Okay, mid-2022. What was the picture then?
That period was marked by high inflation, intense geopolitical uncertainty. You remember it well. At that time, WTI crude oil was trading near $95 a barrel.
95.
It was riding high on post-pandemic demand spikes and, of course, supply fears. Silver, on the other hand, was just kind of hovering around $20 now.
$20. So just a couple of years ago, a barrel of crude oil was worth a staggering, 5.5 times more than an ounce of silver?
5.5 times. The gap was immense. Oil was economically and I'd say symbolically dominant. It wasn't even a contest.
The contrast is just jarring. I mean, it really is. Back then, oil was reacting to scarcity real or perceived in the energy landscape.
Right. And silver was largely treated as, a low-grade inflation hedge, something you bought when you were worried, but not something you expected to lead the market.
So let's look at the performance metrics since then, because the reversal is, well, it's almost unbelievable. It represents this massive rotation of capital and sentiment.
It really does. Give us the numbers on that reversal.
Okay, get ready for this. Since mid-2022, silver has delivered an explosive triple-digit surge. It has gained over 206%.
206%.
Over that exact same period, oil prices, the global bellwether for industrial activity, have collapsed, falling by nearly 44%.
So one is up over 200%, the other is down almost 45%.
This radical divergence is the precise mechanism that created the flip. It's the market equivalent of two ships passing in the night, one just skyrocketing due to necessity, and the other sinking under the weight of, future redundancy.
Future redundancy, that's a powerful way to put it.
Let's nail down the 2025 calendar year performance specifically, because that's really what drove silver decisively across the finish line to overtake oil.
Yeah, the year-to-date performance in 2025 really solidifies these dramatic market dynamics. Silver has had a truly banner year. It's gained well over 150% so far.
150% in a single year.
Which is positioning it for its best annual run since the monumental commodity boom of 1979.
Wow.
We also see some slightly varied sources noting gains between 108% and 115%, but the essential message is crystal clear. Silver is the runaway winner among traditional commodities this year.
That's a monumental performance. It far exceeds gold or any other major metal.
Yeah.
So what kind of weakness is oil exhibiting during that same 2025 calendar year to create the space, for silver to take the lead?
Oil is showing profound structural weakness. WTI crude is down 18% so far in 2025. That marks its weakest year since the disastrous 2020 pandemic crash.
And what's fascinating here to me is that the traditional drivers like geopolitical tensions in the Middle East or Eastern Europe, which usually provide a floor under oil prices, they've been utterly neutralized.
They have. And they've been neutralized by two factors. First, those structural weaknesses in demand we talked about, the secular shift. And second, persistent inventory oversupply concerns. The market just sees too much oil sloshing around.
So if we look at the historical metric, the silver to oil ratio, which for our listeners measures how many ounces of silver it takes to buy 1 barrel of oil, that ratio has reached its widest divergence in favor of silver since 1979 or 1980.
Yes, and the historical significance here is paramount. When commodity cycles reach these major inflection points, especially the ones driven by technological breakthroughs, we often see precious metals leading the way.
But specifically those with high industrial utility.
Exactly. Like silver, this ratio movement suggests a complete reevaluation of global economic input priorities. The market is effectively telling us that the inputs required for the next wave of industrial and digital growth are fundamentally more valuable than the fuels that powered the last wave.
That context is crucial. Okay, now here's where it gets really interesting as we move into section 3, focusing on the catalysts for this silver surge. We need to go beyond treating silver merely as a safe haven asset, although it certainly retains that role.
It does, but that's not the main story.
Right. This is fundamentally about structural, non-negotiable industrial demand.
That is the essential distinction. This is not primarily a gold style monetary trade. In fact, nearly 70% of global silver consumption is now industrial, not investment.
70%.
And that functional necessity makes the demand for silver far more price inelastic in the short to medium term.
Explain what that means, price inelastic.
It means that when global supply chains commit to a material because of its unique properties, they literally cannot function without it, regardless of the price. The price can double, triple, and they still have to buy it because their product depends on it.
There's no easy substitute.
No easy substitute at all.
So let's drill down into the clean energy transition, which is arguably the single biggest driver of this inelastic demand. We're talking specifically about solar power and electric vehicles, right? Areas where silver isn't easily replaced without a massive performance hit.
Precisely. The solar photovoltaic or PV sector it's like a black hole for silver demand. It just consumes more and more every year.
What are the numbers there?
Industry reports show this sector consumed over 5,200 tons of silver just in 2025.
5,200 tons. Can you put that into physical context for us? That sounds like a lot.
It's a huge amount. This demand is driven by the immutable requirement that each standard solar panel needs approximately 20 grams of the metal.
20 grams. Okay. Why? What does it do in the panel?
Well, it comes down to physics. Silver has the highest electrical and thermal conductivity of any known metal, period. So if you want maximum efficiency from a solar panel, if you want to convert as much sunlight into electricity as possible, you cannot substitute silver with a cheaper metal like copper without sacrificing that generation efficiency.
And that's a sacrifice that these massive billion-dollar solar farms, they're just not willing to make.
They can't afford to. The entire economic model is based on squeezing every last watt out of every panel.
So 20 grams per panel sounds small, but if you multiply that by the millions upon millions of panels being deployed worldwide as nations commit to these massive decarbonization goals.
That 20 grams rapidly translates into tons and tons of demand.
Exactly. And the demand growth curve for solar PV is exponential. It directly maps onto the commitment of nations to replace fossil fuel capacity. This isn't optional demand. This is mandated by international and national clean energy policy.
And it's the same dynamic with electric vehicles, but amplified, right? It's not just a marginal amount needed for a few basic sensors. Oh, it's a completely different scale. The shift to EVs introduces massive new requirements. Advanced EV models utilize dramatically more silver than their traditional internal combustion engine counterparts.
How much more?
Up to 10 times more, according to research from the Silver Institute.
10 times. Wow. What is all that silver doing in an EV?
This dramatic increase is driven by really three main factors. First, the vast complexity of the modern wiring harness and control systems. Second, the high conductivity contacts required for the battery management systems. And third, the use of silver-based paste in touch screens, rear window defoggers, and integrated circuit boards.
So it's everywhere.
It's everywhere. Electric mobility is fundamentally defined by high conductivity electronics, and silver is the material of choice for optimal performance and safety.
That makes the utility argument just undeniable. But this demand spike is also intrinsically tied to the growth of the broader digital economy, not just green energy applications.
That's a crucial linkage. Silver is essential for virtually all modern digital infrastructure. We're talking about components in 5G infrastructure, general electronics, advanced batteries, and particularly all the specialized high-performance hardware required for massive data processing and AI-related technology.
So the AI boom is also a silver boom.
In a way, yes. The demand for server farms, high-speed data transmission, and integrated chips is skyrocketing, and silver is a foundational material in all of those systems. The demand is intrinsically linked to the growth of the digital and interconnected economy. It's essentially the global GDP growth curve with this massive energy transition overlay on top of it.
Okay, so we have demand exploding. It's exploding due to mandatory structural changes in global industrial policy. Now let's pivot to the other side of the equation,
The supply side.
the supply side, which is what is making this price movement so volatile and powerful. What is happening with production? Can it keep up?
Because the short answer is no, not even close. The supply side is fundamentally constrained, which is the main factor amplifying this price surge.
How constrained are we talking?
The silver market has experienced a cumulative shortfall of between 800 and 820 million ounces since 2021.
Wait, say that number again?
Between 800 and 820 million ounces. That means 5 consecutive years of severe structural market deficit.
5 straight years.
And this isn't a case of miners just deciding to hold back supply to boost prices. This is a severe supply tightness that the market simply cannot fix overnight, regardless of the price signal.
That is a staggering deficit over half a decade. But here's the question that I think a lot of people would have. If the price of silver has surged by 206% in 2 years, why can't miners just, turn on the taps, flood the market, and capture those massive profits? That's what capitalism should dictate.
It's an excellent question, and this is the critical piece that the average person often misses and why we have to spend time on this point. The challenge is inherent to how silver is typically extracted.
Okay.
Unlike gold, which is generally mined in primary gold deposits, you go looking for gold, you find gold silver is overwhelmingly mined as a byproduct.
A byproduct.
Specifically as a secondary component of larger mining operations, primarily focused on things like copper, zinc, lead, and sometimes gold.
So the output of silver is basically held hostage by the output of other metals.
That's a perfect way to put it, exactly. Imagine a large mining operation dedicated to extracting copper. Silver is simply a bonus metal found in the ore body. Because of this co-product status, mining companies cannot rapidly increase silver production in isolation, even if the price of silver is $65 an ounce.
So to get more silver, they have to mine a whole lot more copper.
A whole lot more copper, which requires massive new capital expenditure, years of environmental permitting, construction of new processing plants, securing long-term debt. It's a massive and slow capital undertaking that can take 5 to 10 years to come online. You cannot just flip a switch to solve a silver deficit.
That deeply, deeply explains the structural deficit. So the supply is inelastic, the industrial demand is inelastic. That creates an almost perfect bullish setup.
It does.
But the rally also benefits heavily from the broader macroeconomic environment, specifically the policies coming out of the Federal Reserve and the dynamics of the U.S. dollar.
That's where the investment side intersects with the industrial story and pours gasoline on the fire. The U.S. Federal Reserve's recuts in 2025 significantly reduced the opportunity cost of holding non-yielding assets.
Right, so cash in the bank isn't earning you much.
Exactly. When the money you hold in cash or short-term treasuries yields less than it used to, that cash suddenly looks very unattractive. This encourages institutional and retail investors to reallocate funds into commodities like silver, which, while non-yielding, promise massive capital appreciation fueled by this industrial necessity story.
And the dynamics of the U.S. dollar has played a major role in making silver accessible and appealing to international buyers.
Absolutely. The U.S. dollar depreciated by 8.5% in 2025. This weakening dollar immediately amplifies silver's appeal on 2 fronts.
Okay, what are they?
First, since commodities are priced in dollars, a weaker dollar makes dollar-denominated silver cheaper for buyers using euros, yen, or rupees. That stimulates international demand right there.
Makes sense.
Second, it enhances silver's existing traditional role as an inflation hedge and a store of value against currency debasement. When the dollar loses purchasing power, people globally flee to hard assets. It's a tale as old as time.
The result of this confluence of exploding industrial demand, severe structural scarcity, and these monetary tailwinds is just spectacular outperformance, as you noted.
It is. Silver's rally of anywhere from 108% to 150% in 2025, depending on the source, highlights its new role as a high conviction holding, far outpacing other assets.
And to contextualize that, how did gold do?
Gold, the traditional monetary king, also saw strong gains. Don't get me wrong, it was up 50% to 70%. But silver significantly outpaced gold, and that reflects a real shift in investor conviction.
And they're buying the growth story.
They're buying the industrial growth story. They're viewing silver as a necessary component of global progress, not just a static store of wealth.
Okay, now we have to transition to the flip side in Section 4, oil's headwinds in the broader asset context. We've established that oil is struggling badly, but it's still the lifeblood of global logistics today. Why is the king of commodities suffering so badly right now, even amidst persistent geopolitical tensions that would usually send prices soaring?
Oil is truly facing a perfect storm where short-term cyclical weakness is meeting long-term secular doom. It's getting hit from both sides.
Let's break that down. What's the cyclical side?
On the cyclical side, demand is simply soft. We are seeing sustained pressure from sluggish economic activity, particularly in major consuming regions like Europe and China, where growth expectations have been repeatedly revised downward. Global factories just aren't running at full tilt, and that means less demand for immediate diesel and oil inputs.
And the supply management mechanisms like OPEC plus Kurtin, they aren't delivering the desired result. The market doesn't seem to believe them.
Correct. The market's faith in the effectiveness of the OPEC plus production cuts has been limited by persistently elevated global inventories, especially in key storage hubs. The market sees a structural imbalance despite the cuts.
And we saw that play out around December 17th, didn't we?
We did. The oil price plunged around then, with WTI dropping toward $55. And what's interesting is that it was exacerbated by optimism over a potential Russia-Ukraine peace deal.
Right. So a good thing for the world was a bad thing for the price of oil?
Precisely. Geopolitical risk is typically oil's strongest driver, but even a potential lessening of that risk premium was enough to accelerate the price decline. That just showcases how fragile the underlying demand picture really is.
This suggests that while cyclical issues are hurting oil today, its struggle is fundamentally tied to these long-term secular trends that are, for all intents and purposes, irreversible.
That is the key takeaway for our listener. Oil's valuation is being challenged by the accelerating energy transition globally. The shift toward electric mobility, the rapid deployment of solar and wind power, regulatory efforts to phase out fossil fuels.
It's all eroding the long-term demand certainty.
Exactly. The certainty that oil producers once relied upon is gone. It means that every barrel sold today is viewed as less essential tomorrow.
It's a reevaluation of fundamental economic importance based on a future timeline. Speaking of reevaluation, this massive commodity shift offers a great opportunity to connect the performance of other major alternative and digital assets that investors are looking at, specifically Bitcoin.
Right. When traditional asset valuations are thrown into question like this, investors look for alternative non-fiat stores of value. And we need to look at Bitcoin's trajectory to see how digital assets have fared in this volatile period of transition.
We have data tracking Bitcoin's year-end valuation over a decade, right? And it shows this volatile yet persistent nature of digital assets.
It does. It's a fascinating chart to look at.
So let's trace that historical price action just to appreciate the context. Bitcoin closed 2013 at what, around $755?
$755. Seems like a different world, doesn't it?
It really does. After a period of quiet, it had that huge run-up, hitting $14,155 by the end of 2017, which was seen as explosive at the time.
And that volatility just continued. It recovered strongly after subsequent corrections. By the end of 2020, it was at $29,000. Then it soared to $49,305 by the end of 2021.
And the big peak was in 2024.
The significant run-up peaked high in 2024 at $95,650. However, the data for year-end 2025 shows a slight retreat from that peak, down to $87,580.
So it's still volatile.
It's still volatile, yes. It suggests that while it remains a high-value asset and a powerful store of wealth, it retains that characteristic boom and bust cycle that investors still differentiate from physical commodities.
But even with that slight retreat in late 2025, Bitcoin's continued valuation near $90,000 is feeding into the broader investor search for non-fiat stores of value, right? It proves that people want assets outside the traditional banking system.
It absolutely does. The sentiment driving flows into Bitcoin, gold, and silver is very similar at its core. Having highly liquid, decentralized wealth is seen as paramount.
And some investors are now looking at BTC because gold and silver have run up so much.
That's part of it. Some are actively looking toward BTC as another non-fiat store of value, especially given the rapid and spectacular appreciation of physical metals in the current environment. They're seeking diversification from traditional currencies, viewing all of these assets as hedges against systemic stability risks in the financial system.
A crucial traditional market indicator of this exact sentiment shift is the gold to silver ratio.
Yeah.
Traditionally, this ratio is the thermometer for precious metal sentiment.
And we've seen a dramatic shift here. Historically, just a few years ago, the ratio was over 100 to 1.
Meaning it took more than 100 ounces of silver to buy 1 ounce of gold.
Right. But in 2025, that ratio has dropped sharply from 105 to 1 to a much tighter range of 69 to 1 to 78 to 1. That decline signals a powerful, aggressive shift in investor preference.
So what does that mean practically for you, the listener?
It means investors are pivoting aggressively towards silver's industrial growth story. They are deciding that silver's utility in the green economy makes it a more compelling investment than gold's stability alone.
So the market's casting a vote.
When the ratio falls like this, it is essentially the market casting a vote. It values the future utility of silver more highly than gold's monetary certainty. Silver is now priced in many ways like a technology stock.
That makes the shift from gold to silver completely logical within this context of the green transition.
Yeah.
Okay, let's shift gears completely in Section 5 to look at the immediate real-time trading environment in mid-December 2025. We're pulling data to provide concrete context for where all these assets and related industries are sitting right now, the global market pulse.
And we are pulling data specifically from December 17, 2025, to see how the market was reacting to these powerful macro themes of recession fears, central bank policy, and the tech surge.
What did the U.S. markets look like?
U.S. markets exhibited mixed trading. The more traditional cyclical major indices, the S&P 500 and the Dow Jones, actually saw noticeable declines. They fell 0.24% and 0.62% respectively.
And why was that?
This was directly attributed to general economic concerns pressuring sectors tied to manufacturing and traditional energy consumption. The old economy was weak.
But the tech sector showed the resilience that really underscores the silver side of our story.
Absolutely. While the old economy struggled, the new economy soared. The Nasdaq closed higher, rising 0.23%. And this was driven by sustained, almost frantic excitement over AI and, crucially, electric mobility and autonomous driving technology.
And the perfect example of this is Tesla.
The perfect example, Tesla's shares jumped 3.1% to record highs after its CEO confirmed the company is testing fully autonomous robotaxis in Austin. This just demonstrates a clear bifurcation of capital. Money is flowing aggressively toward future-focused, high-tech enterprises that require high-utility materials like silver.
Switching focus to the currency market, we saw significant volatility, with the Indian rupee showing signs of acute weakness right at this time.
It was a tough period for the rupee, which weakened for a fifth straight session, closing at a new record low.
What's behind that weakness?
This is primarily attributable to ongoing foreign fund outflows, or FIIs, from capital markets, coupled with persistent global risk aversion. In periods of uncertainty, even with a weakening dollar, money tends to leave emerging markets and seek the safety of the world's major reserve currencies, or, ironically, alternative stores of value, which includes the booming precious metals.
Let's delve into the underlying economic data that's influencing central bank policy expectations. What did the crucial U.S. employment report show in November?
The U.S. employment picture was confusingly mixed, which creates a lot of uncertainty for policymakers. Non-farm payrolls rose by 64,000 in November, which actually beat the consensus expectation of 50,000 jobs.
So stronger than expected.
Stronger than expected, but
Right.
simultaneously the unemployment rate climbed to 4.6%, a four-year high.
So we have job creation ticking up while the overall rate of unemployment is rising. How did that work?
It suggests a complex picture, maybe more people entering the labor force and not finding jobs immediately. Despite this volatility, Federal Reserve futures still priced in stable expectations for 2 Fed rate cuts in 2026. The market is betting that growth will continue to slow, necessitating policy easing.
And how is economic activity looking across the pond in the Eurozone, another massive consumer of global commodities?
Private sector growth moderated significantly in December. The HCOB Composite Output Index, which tracks both manufacturing and services, dipped slightly to 51.9.
So still in expansion territory, but just barely.
Just barely. While services were still expanding weekly, manufacturing activity was clearly contracting. This suggested a picture of cooling, differentiated growth enough to temper inflation fears, but not enough to suggest an outright severe global recession was imminent.
Now, we need to address the deep dive into the technical snapshot of the Indian market, specifically the Nifty index, which you mentioned was experiencing significant institutional selling. Let's try to contextualize this technical data for our global listener who may not be an expert in futures and options trading.
That's crucial. The Nifty index was extending its decline for the second consecutive session, closing lower at 25,860.10. And technicians were closely watching a critical level of support, the 50-day exponential moving average, or 50 DEMA, sitting at 25,760.
And for the uninitiated, the 50 DEMA is a frequently watched trend line, right?
It is. If the price decisively breaks below it, it often signals a deepening market correction and can trigger panic selling among trend followers. It's a key psychological level.
And this selling pressure was confirmed by activity in the derivatives market, specifically the futures and options market.
Precisely. The F&O data provided a very clear picture of institutional bearish sentiment. We saw what's called a short buildup in both Nifty and Bank Nifty futures.
Break that down for us. What is a short buildup?
It's a highly technical but easily understandable signal. A short buildup occurs when the open interest, which is the total number of outstanding futures contracts, rises at the same time the underlying price is falling. This indicates that major traders, specifically foreign institutional investors, were aggressively initiating new short positions, betting heavily on a further market decline.
And the numbers bore this out.
They did. Open interest in Nifty futures rose 2.21%, and Bank Nifty futures saw an even steeper 8.59% rise in open interest with falling prices. This means FIIs were actively pouring money into bets that the market would fall. In fact, FIIs were net sellers in the index futures segment, offloading positions worth a significant $1,767 crore. This confirms they were actively initiating net short contracts.
So if we step back, how does this highly technical regional bearish activity relate back to our core macro story about oil and silver?
It connects directly through the theme of global risk and asset rotation. The FII short selling in India is a clear example of global risk aversion. Money is fleeing perceived volatility in emerging markets.
And where does that money go?
It goes into the perceived safety of dollars, treasuries, and crucially, assets that promise non-cyclical structural growth like silver. Bearish sentiment on cyclicals, which includes oil, traditional banking, and emerging market equities, fuels bullish sentiment in assets tied to these irreversible megatrends like decarbonization.
The final nail in the coffin of immediate market confidence was the Nifty put call ratio, which fell significantly.
Yes. The Nifty put call ratio, or PCR, is a key gauge of market sentiment. It compares the volume of bullish calls versus bearish puts. It fell sharply to 0.90 from 1.11. A drop below 1.0 indicates that more puts, which are bets on falling prices, are being bought than calls.
So it's a sign of widespread caution?
Widespread caution and increased resistance. Traders were specifically building massive resistance at the 26,000, 26,100 strike prices, effectively saying, we don't think the market can hold this level. The institutional money is clearly shifting toward defensive plays.
That technical analysis paints a clear picture of immediate caution and capital rotation. But the long-term shift toward green energy and high-tech inputs remains undeniable. That brings us seamlessly to Section 6, Corporate Insights. This is where we highlight specific company news that confirms the underlying structural trends we've been discussing.
This is where the macro narrative is validated by massive, tangible capital expenditure commitments. We move from theory to billions of dollars being deployed into the foundational technologies that underpin silver's rise.
Let's start with semiconductors, a core component of the tech economy, linking directly to the high conductivity needs where silver is indispensable.
Keynes Tech, through its subsidiary, announced two critical strategic partnerships with major Japanese technology leaders, AOI Electronics and Mitsui & Co. These alliances are explicitly aimed at strengthening Keynes' upcoming semiconductor manufacturing operations in India.
So this is a long-term structural commitment.
It's a massive multi-year structural commitment to creating the digital infrastructure that demands these high-end materials. It is a tacit endorsement that the future economy relies on faster, more efficient chips, which inherently means demanding materials like silver.
And nothing validates the energy transition theme more loudly than the staggering capital expenditure announced by Vikram Solar for battery energy storage systems.
This commitment is a critical proof point for the green tech investment thesis. Vikram Solar announced a major capex of approximately Rs 4,371 crores.
And for context, that's roughly $500 million.
$500 million committed to essential infrastructure for phase 1 of its battery energy storage system, or BS, roadmap.
Why is BS so important to our story?
BSS is the crucial bottleneck for renewable energy deployment. Solar panels can only generate power when the sun shines. Wind turbines only spin when it's windy. To make renewables a reliable 247 power source, you need utility-scale storage. You need giant batteries.
And Vikram Solar is building the factories for those batteries.
Exactly. This BSS roadmap includes plans for commissioning a 5 GWh manufacturing facility by fiscal year 2027. Even more significantly, they are pushing backward integration into the core component battery cell manufacturing, aiming for a massive 7.5 GWh cell manufacturing capacity to be fully operational by FY29.
These are the long-term, multi-billion-dollar bets that validate the fundamental, non-negotiable demand for battery metals, which includes silver, copper, lithium, and others.
Yes. This commitment proves that the energy transition is not slowing down, it's accelerating. The capital is flowing.
Let's pivot briefly to the biotechnology sector, which saw a potentially massive high-value licensing deal that shows global innovation continuing apace.
Glenmark Pharma's subsidiary signed an exclusive license agreement with Hansoh Pharma for aumolertinib, which is a high-value treatment for non-small cell lung cancer.
What's the potential value of that deal?
It's structured to yield an upfront low double-digit million USD payment, but the true value lies in potential regulatory and commercial milestone payments that could accumulate to over 1 billion US dollars, in addition to tiered royalties. It just showcases high-value innovation in pharmaceuticals and highlights that these complex, high-margin sectors continue to drive economic growth.
We also saw significant activity in infrastructure and construction, suggesting ongoing domestic growth projects that require materials ranging from steel to advanced electronic controls.
Absolutely. Ahluwalia Contracts received a major order worth Rs 888.38 crore for construction and development work related to the Sri Ram Janmabhoomi Tirthakshetra in Ayodhya. That's a huge project.
And another one for an educational institution.
Right. NBCC secured a project management consultancy services order worth Rs 332.99 crore for IIT Mundi, a crucial educational infrastructure project. These large construction contracts illustrate robust, sustained infrastructure investment flow, a foundational component of global economic health.
In the finance sector, there was movement concerning HDFC Bank's holdings in a peer bank, showing consolidation and strategic interest within the financial services industry.
Yes, HDFC Bank, a financial powerhouse, secured approval from the Reserve Bank of India to increase the collective holding of its group entities up to 9.50% in IndusInd Bank. This signals ongoing strategic maneuvering and positioning within the Indian banking landscape.
And finally, circling back to the green energy theme, we see how companies are financing this aggressive growth, often resorting to high-cost capital because of the speed and scale required.
Alpec Solar provided a perfect illustration of this. They issued high-coupon, non-convertible debentures, or NCDs, worth up to R125 crores. And crucially, the NCDs carry a significant coupon of 14.75% per annum, payable monthly.
14.75%. That's a high price to pay for capital.
It's a very high price. It demonstrates the market's demand for capital even at a high cost to fund aggressive solar expansion. Growth in this sector is so mandatory and fast that companies are willing to pay significant interest rates to secure immediate funding.
And there was another power agreement too.
Yes, NLC India Renewables and SJVN signed a power purchase agreement for a 200 milliW wind power project, which is expected to generate about 500 million units of green energy per year. It just further cements the long-term transition away from fossil fuels.
Yeah, that deep, detailed look at corporate commitments across semiconductors, BS manufacturing, and renewable financing. It completely validates the structural demand side of the silver oil inversion story. This isn't speculation based on a Reddit forum.
Yeah.
It's tangible capital expenditure, betting billions on the necessary green future.
Exactly. The core conclusion we must reach is that the silver oil price inversion is not a random market anomaly. It is a fundamental structural realignment where commodities essential for the energy transition are gaining primacy over traditional fossil fuels. This reflects a radical shift in what the global economy values most.
Which is?
Highly conductive, reliable materials necessary for decarbonization and digitization, rather than simply brute energy inputs. The price inversion is a tangible indicator of this massive societal shift.
So we've established the fundamentals are arguably the strongest they've been for silver in half a century. But what does this mean for the future price trajectory of silver? What are the technical signals suggesting now that silver has decisively broken through old norms and established this new high versus oil?
Well, the market sentiment, according to reports like the HDFC Securities analysis, remains strongly bullish on silver. Analysts are suggesting that any price correction should be viewed as an accumulation opportunity, provided a key support level holds.
And what is that level?
Axis Securities specifically maintains a positive long-term bias as long as the international $50 level acts as a floor. That $50 level is considered the line in the sand. If the price retreats but holds above that, the long-term structural thesis is still very much intact.
And what are the levels analysts are watching for a massive multi-year breakout beyond the current $65 range?
Analysts are watching the immediate resistance level around $65 very closely. A sustained monthly close above $67 per ounce is viewed as the trigger for a major multi-year uptrend.
And if that happens, What are the targets?
Should that happen, the technical targets range between $76 and $80 per ounce. And given the supply constraints we detailed, if industrial demand continues its parabolic climb fueled by BSS, solar, and EVs, it's entirely plausible that silver is entering an extended run, driven by necessity rather than just monetary policy alone.
This raises an important final question, something for you, the learner, to mull over long after this deep dive ends. We discussed how the gold to silver ratio is dropping dramatically, moving closer to historical values seen centuries ago, back when silver was a primary monetary metal.
Hmm.
So if silver's price is truly being driven by non-substitutable industrial demand linked to global decarbonization, a force many believe is irreversible, are we seeing silver reclaim its ancient monetary status, or is it simply proving itself as the ultimate green tech metal of the modern era?
And that's the multi-trillion-dollar question, isn't it? The utility argument for silver is far stronger than it has been at any point since the beginning of the Industrial Revolution. The market is now valuing its essential role in the technology of the future over its traditional, ornamental, or purely monetary uses. The inversion with oil is the ultimate evidence.
So you have to decide.
You have to decide if this rally is a short-term bubble inflated by speculation or if it's a fundamental, long-term repricing of future necessity.
The price of global progress, it seems, is currently measured in ounces of silver, not barrels of oil. A profound thought to end on. That wraps up this deep dive into the historic inversion of the silver and oil markets, a truly once-in-a-generation shift.
Thanks for tuning in.
Thank you for joining us, and we'll catch you on the next deep dive.
You ever get that feeling, that little nagging thought that the systems we rely on every single day, our money, our banks, even the apps we scroll through, might not be quite as solid as we think? Well, today, we're going to lean into that feeling. We're diving deep into the cracks that are starting to show up in the very foundation of our financial and digital worlds.
Right off the bat, you've got two completely different ways of looking at all this. The first one basically says, look, this system has been around forever. It's seen it all, it's created a ton of wealth, and it's not going anywhere. From this point of view, if you're not making it, hey, that's on you, not the system.
But then there's that other side of the coin. The side that just feels like something is off. It's this quiet hum of distrust that seems to be getting louder and louder, Like the ground underneath us isn't as firm as it used to be. So that's the big question, right? Where are we headed? In this explainer, we're going to follow the trail of this growing distrust. We'll kick things off with the very nature of our money, then we'll look at the incredible power these big tech companies have, and finally, we'll explore the really fascinating new paths people are starting to build for themselves. And this quote right here, it just gets straight to the point. Is this a level playing field for everyone? Or is the game kind of rigged from the get-go? To even begin to answer that, we have to go back to square one. We need to talk about money itself. All right, let's get into it. Let's start with the absolute foundation of our entire economy, the money that's in your wallet or your bank account. What actually gives it any value? Well, the answer is this thing called fiat currency. And that's really just a fancy way of saying our money isn't backed by anything physical, like a vault full of gold. Its value comes from just one thing, our shared belief and trust in the government that issues it. That's it. And it's so easy to forget this, but this is a pretty new experiment, historically speaking. For most of human history, money was tied to something real, something tangible. But back in 1971, everything changed. The U.S. snipped the dollar's final tie to gold, and in doing so, kicked off this massive global debate that is still raging today. What is money, really? And who should be in control of it? This slide just perfectly captures the two warring ideas at the center of this whole debate. On one side, you've got the argument that, hey, fiat money is this incredible engine for growth and your success is totally in your own hands. But on the other side, you've got this view that it's actually a system of control, where printing endless amounts of money makes a few people rich, while everyone else's money becomes worth less and less. And if you want the most raw, unfiltered version of that pro-system argument, this is it. It's a direct shot at anyone who blames the system for their problems. The message is pretty blunt. Stop complaining, learn the rules of the game, and play it better. Okay, so let's pull this out of the world of abstract arguments and bring it into the real world. Because what happens when the very system you're told to trust decides it doesn't trust you? What happens when you get debanked? I mean, just imagine this for a second. You wake up, you go to buy your morning coffee, and your card gets declined. So you pull out your phone to check your bank app, and your account is just gone. No warning, no email, no explanation. You've just been cut off. And the way it happens is as simple
as it is completely terrifying. You get a cold, formal letter in the mail, your access to your own money is just switched off, and when you call up demanding to know why, you just hit a brick wall of silence. It's a pretty harsh reminder of who really holds all the power in that relationship.
And look, this isn't just about catching criminals. This deep banking dragnet is sweeping up all sorts of people and businesses that are completely legal, but are just seen as too risky or maybe too controversial for the big banks to deal with. And this is why it's such a huge deal. I mean, think about it. In a world where you can barely function without a bank account, getting debanked is like being completely kicked out of the economy. It's a massive tool of control, and it's being used more and more often.
So, this whole struggle over control and ownership, it isn't just happening in the banking world. There is another quiet revolution brewing, and it's happening right where so many of us spend our time: online. We are living in this age of just infinite content, right? Trillions of views, millions of creators, a constant fire hose of stuff to watch and read. But have you ever really stopped and thought about how all of that creativity, that attention, that value is actually measured? You can think about it like this. The old model is basically like a TV network. The value of a show is decided by how much a company is willing to pay to run ads during it. But this new model, it's more like a stock market for ideas. The value of a creator or a video is decided directly by the community that believes in it and rallies around it.
And if you're wondering who's winning in that old model, well, just look at these numbers. We are talking about tens and tens of billions of dollars every year flowing straight into the pockets of just a few massive tech companies. This is the giant pot of gold that the new model is trying to pry open. And really, this is about so much more than just a new way to make money. It's a totally new way of thinking about what it means to create things online. It's the difference between being a small gear in someone else's giant machine and actually being the architect of your own world.
So, we've looked at the problems. We've seen the cracks in the old systems and the rise of these new ideas. But what are people actually doing about it? Let's take a look at the new paths that are being built as we speak. It's almost like a choose-your-own-adventure for the future of finance. You've got Path 1, go back to basics. Gold, silver, things that have held value for thousands of years. Path 2, jump into the future. Build brand new systems from scratch with decentralized tech. Or Path 3, master the current game. Learn every single rule of the system we have now and use them to your absolute advantage. And for the people choosing that first path, the hard assets path, this is the kind of data that really gets them going. It's a simple equation, really. You have more and more people wanting to buy something that's getting harder and harder to find.
So, where does that leave us? What does all this mean? Are we watching the slow motion collapse of the systems we've known our whole lives? Or are we actually in the middle of building something new, something different, maybe even something better? The final answer isn't written yet, but one thing is absolutely for sure. The world is changing, and we all have a choice to make. Which path do you think you'll take?
Unlock the future of fiduciary operations with JusticeFund, the digital platform that reshapes judgment claims and bills of exchange into efficient digital workflows. Experience advanced claim management with automated workflows, real-time updates, and secure exchange processing. Stay ahead with comprehensive compliance and reporting tools enhanced by military-grade multi-factor authentication and end-to-end encryption. Enjoy peace of mind with our platform's 99.9% uptime and record of zero security breaches. JusticeFund seamlessly integrates into your existing technology, slashing processing time by up to 70% and cutting operational costs by 65%. Benefit from customizable dashboards, advanced analytics, and dedicated support tailored for fiduciary professionals. Rest assured knowing that JusticeFund guarantees compliance with federal, state, and international regulations. Join the revolution in fiduciary management today with JusticeFund, your partner in efficiency and security.
Welcome to the Deep Dive. Today, we are plunging straight into the heart of financial autonomy. We're doing a detailed analysis of how you, the individual, can secure your assets, truly leverage their value, and build lasting wealth.
And we're doing this in a global system that, let's be honest, increasingly feels unstable, centralized, and, well, kind of determined to exert control over your economic life.
Exactly. And the sources we're pulling from for this deep dive they're incredibly broad. We've got everything from personal trustee management all the way to global monetary systems.
Right. And the mechanics of the silver market, the future of creative value, it's a huge spectrum.
It is. But the mission here is really singular. We need to synthesize actionable, practical insights from all of these different viewpoints. We want to guide you toward a mindset of proactive financial security.
And that means understanding not just the defense you need to play against external threats, but also, establishing the internal discipline you need to actually capitalize on opportunities.
It's a two-sided coin. So the main idea connecting all these sources is this dual challenge that you have to overcome for real financial security.
That's right. On one side, you have the internal enemy, procrastination, lack of structure, the failure to plan ahead. One of our sources calls it the 11th hour mentality, which is a perfect description.
And on the other side,
the external adversary, the centralization, the surveillance, the manipulation, and the very real threat of being cut out of the economy through things like debanking.
Our analysis shows that trying to fix one without the other it's a recipe for failure. You can't build walls around a house if the foundation is crumbling from the inside.
Exactly. So let's unpack this, starting with that internal structure, the discipline required to manage your assets effectively in the first place.
Let's do it. Let's start right there with that internal problem, because it's surprisingly common. I mean, even among high net worth individuals and trustees who've already taken the big step of setting up a trust.
Right. They have the vehicle, but not the roadmap.
And the sources highlight this thing they call the 11th hour transfer mentality. This is where trustees are waiting into the last 5 days of the year,
or sometimes literally the day before the last day,
to make these critical, time-sensitive decisions about distributions or other financial transfers. It's wild.
It is the ultimate crisis-driven approach to wealth management. I mean, instead of treating the trust like a functioning, ongoing business, they treat it like a chore, something you put off until the absolute last second.
And the core insight from the sources is, well, it's simple, but it's profound. You cannot operate a trusteeship properly without executing formalized trust minutes and having regularly scheduled meetings.
Mandatory meetings. They have to be on the calendar.
And the absence of those meetings is the root cause of the whole problem. If you don't have consistent, structured appointments, monthly, biweekly, whatever, you just inevitably fall into that last-minute trap.
It's kind of baffling, isn't it? That people who are entrusted with managing a multi-million-dollar family estate would apply less structure to it than they would to, say, an entry-level job.
Exactly. And that haphazard approach, it stems directly from what the sources call a job mentality.
Can you break that down? What do they mean by job mentality?
Well, if your planning is always driven by a deadline, you're operating with the mindset of someone who just, punches a clock to get a paycheck.
It's reactive, not proactive.
Right. And that mentality is described as thwarting creativity. It keeps people just doing the bare minimum to avoid immediate consequences instead of thinking bigger.
But operating a trust or managing an estate, that requires an offensive growth mindset. In business, your compensation is tied to the size of the problems you solve, right?
Of course.
A trustee's job is to solve huge, complex problems. Asset preservation, minimizing liability, generational transfer. That requires the systems and routines of a massive, successful company, not the mindset of a wage earner.
And the proof is in the pudding, as they say. If you've gone to all the trouble of setting up a trust structure, but you still have a significant tax liability every year, that is a clear sign you're stuck in that job mentality.
You're still thinking passively, like, oh, I have a job, they have to take taxes out. It's just not compatible with true wealth management. Your focus has to shift aggressively to minimizing or even legally eliminating that liability.
Let's dig into the tax implications here, because this is where that inaction really costs you. The sources are incredibly emphatic about this.
Oh, yeah.
Anyone making over $150,000 a year must have a proactive tax plan, especially if you hold complex assets like real estate or you run multiple businesses.
Yeah.
If you don't, you are just getting eaten alive by employee taxes.
Eaten up specifically by self-employment payroll taxes. That's the real killer.
So why is that $150,000 number so important? What happens at that threshold?
Well, it's really about the efficiency of your business structure. Once you cross that line, the burden of Social Security and Medicare taxes, which is often around 15.3% before income tax, it just becomes crushing.
Ouch.
Yeah. A proper tax plan can strategically shift how you're compensated or use different entities like an S-Corp to significantly minimize that payroll tax hit. the wealthy use foundations, for instance.
All right. And not just for philanthropy.
No, not at all. Fundamentally, it's to lower their adjusted gross income and therefore their overall tax burden.
So the mistake a lot of people make is thinking that just setting up the trust or the foundation is the end of the road.
Exactly. That's just buying the shovel. If you don't follow through with a written, proactive tax plan that you execute all year long with minutes and scheduled distributions, you've paid for a sophisticated tool that's just sitting in the garage collecting dust.
And this really highlights a core psychological difference between a poor or middle class mentality and a wealthy mentality. It's all about how you view upfront costs.
Absolutely. A person operating from a scarcity mindset might see the cost of a comprehensive tax plan, say a few $1,000s, as just an expense, an unnecessary expense.
And that is the ultimate trap, isn't it? You're focusing only on the cost and completely ignoring the value it creates.
If that initial investment of a few $1,000s lets you legally lower your annual tax bill from, say, $50,000 down to zero, that cost pays for itself almost instantly.
The wealthy are always focused on becoming more efficient, more effective. They see professional costs as investments that are going to yield huge returns down the line.
So the simple fix for trustees stuck in this 11th hour cycle, it really just boils down to imposing business level discipline on the trust.
The recommendation is pretty straightforward. Set formal, non-negotiable meetings. One suggestion was to schedule time every Sunday night or Saturday morning to review the past week and set goals for the next one.
And crucially, you have to document the trust minutes. This isn't just busy work.
No, it's a legal requirement in many ways.
It's your legal armor. These minutes are formal records that prove the trust is operating as a separate entity, not just as your personal piggy bank. The IRS looks for this evidence of separation.
So the minutes should include what exactly? Distribution decisions, investment reviews.
Everything. Asset valuations, appointing or removing advisors.
Yeah.
Without that paper trail, the entire trust structure is vulnerable. A regulator could just collapse it.
And it's essential to connect the action to the why. You wait until the last minute because you didn't have a goal for a distribution in the first place.
Goals drive distributions. It's that simple. If your family estate has clear written goals funding education, buying a new asset, you naturally plan the transfers in advance. You're not waiting for a tax deadline to force your hand. It's about proactive intention versus reactive compliance.
That's a powerful internal shift. It requires taking full responsibility. One source made a great point. The moment you start blaming external factors, the government, the central bank, for your financial situation, you've already lost.
You have to master the rules of the system that exists right now, even while you're preparing for it to change or fail.
And that necessity brings us to our transition. Once you've established that internal discipline, you have to turn your attention to the external environment,
which is becoming increasingly hostile to individual financial freedom.
Precisely. So let's connect this need for internal control to the massive challenges from the external system, starting with the hidden risk of debanking.
Debanking. This is maybe the most dangerous threat to economic freedom today because it happens in the shadows. We're talking about the abrupt, unexplained closure of a bank account.
And this isn't just happening to, shady actors.
No, not at all. It's happening to legitimate companies, established foundations, regular people, sometimes after decades of a perfectly good banking relationship.
The process itself is chilling. The speed and the finality of it. You just wake up one morning to a letter, your account is closed, you have a very short window, maybe 24 hours, to move your money.
For a small business that relies on that account for payroll or payments, that can trigger bankruptcy in a matter of days. It's devastating.
And we often think it's malicious, but the sources point to something deeper, more systemic. It's regulatory overreach.
It's the vagueness of the rules. Specifically, things like the Bank Secrecy Act, the BSA from 1970, and all the various anti-money laundering or AML laws.
Can you break those down quickly? What makes them so problematic for an average person or business?
Sure. So the BSA requires banks to keep detailed records and report certain transactions, basically to create a paper trail for the government. AML laws are the broader framework to stop criminals from laundering money. The problem is the requirement to file a suspicious activity report, or SAR.
And the criteria for what's suspicious is
incredibly vague. And banks face massive fines, billions sometimes, if they fail to report something a regulator later decides was suspicious.
So the bank's internal calculation becomes very simple. It's better to just cut off any client who poses even a tiny risk of causing a regulatory headache.
That is the chilling effect, precisely. Banks preemptively debank clients in entire industries that are deemed controversial. This could be free speech nonprofits, crypto companies, even humanitarian aid groups working in certain parts of the world.
And the bank isn't doing it because the client is a criminal.
No, they're doing it to avoid the administrative costs, the oversight, and the massive potential fines associated with that perceived risk. It's a business decision for them.
And the most frustrating part is the total lack of due process. When you ask the bank why they closed your account, what's the answer?
We are prohibited from telling you the reason.
Which sounds insane.
But that prohibition is literally written into the AML laws. Once a bank files a SAR, they are legally forbidden from telling the subject of the report. The idea is to not tip off criminals.
But the consequence is that millions of innocent people get their economic access terminated with no explanation, no appeal, no transparency.
It's economic censorship disguised as compliance.
And there's a huge, unforgettable example of this from the sources. The Canadian trucker protests in 2022.
Right. That was a crystal clear demonstration of the state weaponizing financial access over a political disagreement. It wasn't just organizational accounts like GoFundMe that were frozen.
It was individual personal bank accounts too, just completely cutting people off from their own money.
And if we project this whole debanking phenomenon onto the future of currency, the picture gets a lot darker. This is where central bank digital currencies, CBDCs, come in.
Which are seen by many as not just an upgrade to fiat money, but as a path to complete financial control.
They're designed to eliminate the last few frictions and protections that still exist in our current system.
What do you mean by friction? And why is getting rid of it so dangerous?
Friction refers to the legal and administrative barriers that currently slow down the seizure of funds. For example, you generally need a court order to freeze a bank account. CBDCs are direct liabilities of the central bank. They exist on one centralized, traceable ledger.
So getting rid of friction means getting rid of the middleman, the commercial banks that provide a small buffer.
Exactly. And the consequence is that problems like a lack of privacy and due process get magnified to an extreme degree.
The fear is a pretty dystopian future, right? Where your bank account is tied to some AI that monitors your speech or your carbon footprint.
That's the fear. You post something controversial, your funds are instantly frozen. Your CBDC could be programmed with expiration dates or spending restrictions, no human review, no appeal. It's the ultimate totalitarian financial system.
Okay, so given that systemic risk, what are the actionable strategies the sources recommend for protecting yourself?
It's complex because the advice is so case by case. It depends on your public profile, your liquidity needs, your risk appetite. But we need solutions at both the policy level and the individual level.
At the policy level, it's about advocacy.
Yes, speaking out to Congress. We need deep reforms to the Bank Secrecy Act to mandate due process. Compliance needs to be objective and transparent, not subjective and political.
And individual.
You have to build a backstop the centralized system cannot touch. That means strategically holding hard assets, physical gold and silver, decentralized digital assets like Bitcoin. If your entire life is dependent on fiat dollars in a bank, you are structurally vulnerable.
So the theme is dual. Manage your internal finances with the diligence of a great business, and at the same time, build decentralized walls around your assets that the control system can't reach.
And that transition takes us perfectly into how we claim and secure that value, looking at two very different approaches.
Right. The new decentralized digital attention market and the ancient physical commodity markets.
Let's start in the digital world with content creation. The sources are all in agreement here. The current creator model is deeply, deeply broken.
Creators are the engine of the internet. They generate trillions of views, billions in profit for big tech, but their personal income is often stagnant or erratic.
And the core flaw is how they get paid. The value of a creator's post isn't tied to its quality or its impact. It's based entirely on what an advertiser will pay to interrupt the content.
You're paid for the intrusion, not the creation.
Exactly. And this leads to insane geographic inequality. A brilliant creator in Nigeria could get the exact same watch time as a creator in the US, but earn a tiny fraction of the revenue.
Because the advertiser's budget is based on the perceived buying power of the audience's location.
Right. The creator is completely cut out from setting the price of their own work. It obscures the true value. I mean, an internet post is a unique asset, but unlike a painting or a song, it only generates these vanity metrics likes, views that don't translate into durable value.
But we know the content is valuable because of brand deals.
That's the proof. A brand will pay thousands, way more than the platform ever would, just to be associated with that creator's audience. It tells you the post is worth far more than the creator is capturing. The platform is just a very efficient value siphon.
So the big idea to fix this is the attention market. What if posts could be treated like real assets?
Where the price is set by audience belief and cultural demand, not by advertisers.
And this is where decentralized protocols come into play. We're seeing this with platforms like BaseApp, which uses protocols like Zora.
Zora is built on blockchain. It allows digital objects like a creator's profile or even a specific viral post to be minted as tokens, like NFTs.
So how does that let them launch a market for a profile? Can you simplify that?
It's simpler than it sounds. When a creator tokenizes their profile, they're basically creating a tradable asset. The community can then collect these posts by buying the token.
And as more people buy and trade it, the price goes up.
Exactly. And the fees from every trade flow directly back to the creator and often the early collectors. It shifts the power dynamic completely.
So the creator and their community earn directly from the trading volume. It closes that gap.
%70.
Wow, it's in solar panels, EVs.
Directly back to the creator and often the early collectors. It shifts the power dynamic completely.
So the creator and their community earn directly from the trading volume. It closes that gap between value created and value captured.
It turns posting into asset ownership. It makes creativity a truly viable career path.
Okay, now let's pivot from the digital world back to the ancient physical assets that stand completely outside that control grid, gold and silver.
And the sources emphasize that silver, specifically, is going through a critical dual stress test right now that's rapidly revaluing it.
A dual test. What are the two pressures?
It's the simultaneous pressure of overwhelming industrial demand and increasing investment demand. The industrial part is key. Silver is indispensable for modern tech. In 2000, industrial use was about 30% of the market. Today, it's 70%.
Wow, it's in solar panels, EVs, electronics.
Almost everything. And the supply fundamentals are alarming. The market has run a production deficit for 5 straight years. The 2025 deficit alone is estimated at over 117 million ounces.
So industrial demand is just consistently outpacing what miners can pull out of the ground.
By a lot. This confirms a basic reality. The world needs more silver than is being produced, and the market is finally being forced to acknowledge that it's fundamentally mispriced. Industrial users are now focused on securing supply first and price second. That's a sign of profound market stress.
And the performance data reflects this. 2025 was the best year for gold and silver since 1979.
Gold saw a very robust 65% increase. It's doing its job as the ultimate insurance policy against eroding trust in government debt.
But silver was a real standout.
Oh, yeah. It jumped 2.5 times, 150% gain from late 2024. But we shouldn't forget the others. Platinum was up 125%, palladium up 79%.
So this brings us to that core philosophical question from the sources. What is the fundamental difference between these hard assets and the fiat currency we were talking about earlier?
This is central to the whole sound money argument. Gold and silver are defined as money. They're a concentrated form of economic energy chosen by humanity over 6,000 years for their scarcity, durability, and intrinsic value.
Whereas stocks, bonds, crypto, Those are investments.
Right. They're a claim on a future revenue stream or a technology.
And the paper dollar.
The paper dollar is defined as an instrument of credit and debit. It's designed to facilitate expansion within a debt system. It is not a store of intrinsic value because it can be created without limit.
And the fundamental risk there is inflation.
Inflation is the relentless enemy of accumulated wealth. It constantly erodes the purchasing power of that instrument of credit. That's why you need a hard asset backstop.
The discussion of fiat currency naturally leads to the critique of the entire system, which is built on debt and credit. But it's important to approach this with some balance, right?
Absolutely. The sources offer a counterpoint to those who just condemn the fiat system outright. They suggest that can be a loser mentality driven by fear. They remind us that, for now, fiat is a functioning commodity, and the US dollar is still one of the world's strongest currencies.
That's a fair point. But the gold bugs, they have a deep historical complaint that goes back to the 1970s.
Right, to President Nixon's decision in 1971 to unilaterally end the gold standard. He completely severed the dollar's link to physical gold
Which is often cited as the original sin of modern finance.
because it effectively removed the spending limits on the government. Before 71, the government could only print currency proportional to its gold reserves. Afterwards, it could create currency limitlessly, which paved the way for the massive debts we see today.
And whether you think the fiat economy is sound or not, this belief in active market manipulation is pervasive among hard asset advocates.
The theory is that the price of gold is deliberately and systematically kept artificially low by a coordinated effort between the US government and Wall Street.
All to maintain global confidence in the dollar.
And the evidence they cite includes things like these suspicious, massive sell orders that appear out of nowhere. There was a famous one in 2013, a 2 million ounce gold sale that instantly drove the price down and halted trading.
And critics argue the whole point of that is to suppress the price so big institutions can buy up physical gold on the cheap.
Exactly.
So who are the alleged manipulators at the highest level?
They're the members of the President's Working Group on Financial Markets, known informally as the Plunge Protection Team.
That sounds like something out of a movie.
It does. Officially, it's headed by the Treasury Secretary, the Fed Chair, the head of the SEC. Their official job is to enhance integrity of the markets. But critics allege they meet secretly to coordinate manipulation suppressing gold prices, propping up stocks, all to prevent systemic collapses and maintain artificial confidence.
And this gets an international angle when you look at those WikiLeaks cables.
Right. A 2009 cable revealed that China's financial leaders explicitly believed the U.S. was actively suppressing the price of gold to strengthen the dollar's position as the world reserve currency.
That's critical context. While the U.S. was allegedly manipulating the price down,
China was secretly buying up hundreds of tons of gold for its own reserves, basically taking advantage of the manipulated price.
this leads us right to the gold hoard controversy. The U.S. claims to hold the largest single gold holding in the world, over 8,000 tons.
Right, stored mostly at the New York Fed and Fort Knox. The controversy is that the New York Fed also stores gold for other countries,
And in 2013, Germany asked for 300 tons of its gold back.
and the Fed gave them the big stall. They said due to logistics, the delivery wouldn't be complete until 2020.
7 years to move 300 tons of gold. That sounds highly suspicious.
It absolutely fuels the speculation that the U.S. doesn't actually have all the gold it claims, that it's been sold off or used as collateral for U.S. debt.
And this leads to that almost cinematic anecdote about the ultimate shell game between the New York Fed and JP Morgan Chase.
It's a fascinating conspiracy theory, but it's rooted in physical geography. The Fed vault and the JP Morgan vault are right across the street from each other in Manhattan, both 5 stories underground at the exact same level.
And the speculation is there's a secret tunnel connecting them.
A secret, regulated passageway. The theory is it allows them to share a single small pool of physical gold. When an auditor or a foreign nation demands to see the gold, they can quickly shuffle it between the vaults, creating the illusion that both have massive reserves.
A physical game of 3-card Monte to maintain confidence.
That's the theory.
Now, moving from those theories to current market dynamics, we're seeing real quantifiable stress in the silver market that suggests any paper manipulation might be breaking down.
Yes, there is a massive arbitrage opportunity right now. The physical price of silver in Shanghai, for example, is significantly higher than the price in the US or London. We're talking a spread of about $9 an ounce.
And that spread confirms a deep dislocation between the physical market in the East and the paper market in the West. But it's hard to exploit that arbitrage, right?
Incredibly difficult. You have to understand how the Western price is set.
It's mostly based on derivatives, on futures contracts.
Precisely. The COMEX spot price is based on trading these paper contracts, which are essentially promises to deliver metal in the future. The volume of paper traded is many, many times larger than the actual physical supply of silver, which allows the paper market to dictate a lower price.
So if you wanted to exploit that $9 spread, what are the barriers?
They're huge. Transport alone is about $3 an ounce, but the real barriers are capital, insurance, and risk. You need massive capital to buy the physical metal. Then you have to insure it, transport it securely, and most critically, you have to hedge the price risk while it's in transit.
So if the COMEX price drops while the silver is on a boat, your margin disappears.
Your $9 margin could shrink to nothing. That's why the spread persists. But the critical takeaway is that the market is in true price discovery for silver for the first time in modern history.
Unlike the 1970s run-up, which was speculative.
This is driven by industrial users. They are desperate to secure supply, not just negotiate a paper price. That is a fundamental, non-speculative shift that you cannot ignore.
This high-level view of market stress brings us back to personal strategy. If we accept the need for internal structure and the reality of external fragility, how should the individual listener position their assets?
Well, we have to emphasize we are not giving financial advice, but the sources provide a sound traditional principle. Nature preaches balance. You have to avoid chasing a hot market with everything you have, but you have to be positioned to protect yourself.
So let's review that classic rule of thumb for asset allocation.
The age calculation. Take 100 minus your age. That remainder is the percentage of your assets you should hold in risk assets, stocks, real estate, things like that. The age number itself is what you should hold in safe assets.
So a 40-year-old would be 60% in risk assets, 40% in safe assets.
Exactly. But the sources for the Sound Money Advocate modify the definition of safe assets.
They expand it.
They do. Safe assets should be defined as gold, silver, and high-quality liquid cash. The recommendation is to have an emergency fund of 6 to 12 months of expenses and then split that 50-50. Half in liquid cash in a bank and half in precious metals stored outside the banking system.
Can you give a quick example?
Sure. If your monthly expenses are $4,000, you need a $48,000 emergency fund. You'd hold $24,000 in liquid cash and the other $24,000 in physical precious metals.
And within that precious metals mix, what's the recommended balance?
It should be weighted heavily towards stability. So typically 75% to 80% gold and only 20% to 25% silver. Gold is the preservation asset. It holds value. Silver is the volatility asset. It has higher potential upside, but also higher risk.
And finally, the most critical part is discipline, which brings us full circle. The source is cautioned against trying to time the market.
Timing the market is just speculation. The disciplined approach is to use dollar cost averaging. Buy on a structured schedule, maybe once a month for 6 months to build your position. It replaces impulsive, fear-driven action with systematic, strategic accumulation.
So what does this all mean when we connect all these dots? The core tension seems pretty clear.
It is. We are seeing an acceleration in the physical commodity markets. Gold and silver are reacting to real-world forces. And at the exact same time, we're seeing an acceleration in the control mechanisms of the centralized system, debanking CBDCs.
The path to security then is multifaceted. It demands action on two fronts.
Yes, it requires a rigorous, active defense, proactive personal planning, trust meetings, tax plans, and it requires passive decentralization, claiming the value of your work through new models like attention markets and holding physical assets that exist outside the electronic control grid.
So if we accept the premise that gold and silver are simply concentrated economic energy, and that government systems built on limitless fiat are designed to steal that energy through debt and debasement, then the question of true freedom becomes intensely personal.
You have to decide where you will put your economic energy. Will you place all your faith and your fortune in a centralized system that has proven itself fragile and controlling? Or will you allocate a meaningful portion of that energy to an asset, gold and silver, that has outlived every system, every empire, and every government that has ever tried to control it?
The knowledge is now yours to synthesize and apply.